close some of these windows.
Yeah. I love it. Buenos dias, buenas noches, buenas tardes. Doesn't matter what time of the day you're seeing us. Hello, everyone. Welcome to one of my few favorite letters, TGIF. Thank God it's Friday, and it is my other three favorites. Real Estate Unwrapped.
EU, yes. Good morning, guys.
Always the best time. What's going on, everyone?
You know what's another one of my favorites?
What's that?
What is it?
CTC, clear to close. Let's go.
Yeah, man. That's the best one yet. That's amazing.
All right. So how was your week, guys?
Oh, man, it was impeccable.
Pretty good week. I actually got one of those board approvals going on, which is I'm happy to hear that already. So got a listing appointment coming up this Saturday. See how that works out for me. Got open houses, set up already for this weekend as well, which I'm ready for it. And buyers are just coming out of different directions nowadays. Everybody keeps saying the interest rates are just, oh my God, they're going crazy. But one of the few things I always say is like, it's been like this 6-7 months already. Don't worry about this. The numbers are there. You just have to be financially sound to actually buy your next place. And buyers are coming out. That's a good thing about it. And that's what we want, to actually buy these units out there. So, what about you guys?
Notice, Ed? Did you notice more traffic on your end?
I mean, to be honest, I've been in a lot of traffic since January, and it hasn't slowed down.
That's I know. I've seen your stuff. That's
but
good.
Yeah, there's a lot, man. There's people. Listen, people are still looking.
That's right.
People are still looking. I can't even begin to go back and forth on this stuff, man. But luckily, like I mentioned last time when I was out in the market, 30, 40, 50K over ask wasn't even working, man. For like a good house, a good, decent house that was priced right. You're looking at almost 60K over ask, man, which is crazy.
Yeah. As discussed last week, I have a lot of agents who are having we're doing a lot of powwows. We're going back over again what we're going to be discussing today. Their pre-approval, which bank are those buyers using? Is it really helping them? How are we structuring the deals? How are we presenting the offers? It's like, how do you come on to the listing agent? What's up? There's a lot of things that we have to take into consideration to bring a strong offer, even if your terms are not the strongest. So it's up to the agent. We need to build skills as far as offer presentation. That's no doubt.
Absolutely.
There's a lot that gets involved, right? There's a lot that we go through, but ideally at the end of the day, I think one of the more important factors is if you're on the buyer's end or if you're receiving an offer, right? We're dealing with a mortgage sometimes, most of the time. I know we got cash buyers out there that are coming in, placing offers.
Yeah. With the little gold bars and everything.
Yeah, most of the time, it's with the mortgage. So we do have a special guest, right, Israel?
Oh yeah,
absolutely, yeah. So we have Amrish Dias with Cardinal Financials, and look, I've known this man since I started the company. I started real estate for a very long time.
We've known this man since we were with Exit.
Yeah.
Now that we're dropping names, it's been more than 10 years.
Damn.
Yeah. Well, for me, 10. I don't. That's all I have to say. But one thing's for sure, he's a great person to be with. Very knowledgeable about mortgage. Very attentive when it comes to clients.
A good human being too. Yeah.
Good human being. He's helped out my parents in their mortgage situations. Look, I don't put everybody in front of my parents, so let's just put you that way.
First of all, this guy is famous. All right, let's not even not leave that part out. This guy rubs elbows with some of these top famous individuals. So, I got to give it to him, man. This guy is where everyone wants to be. So it is a pleasure. It is an honor to have you on the show. So
let's just put him on.
Bring him up.
There you go.
Yeah.
Hi guys.
How you doing, sir? Welcome.
Amrish. Yeah, we were saying it's been a long. We know each other for a long time. We haven't seen one another in a long time.
I've known him for 5 years. I think.
Oh my God, we probably have known each other what are we, 20, like literally probably 12, 13 years now.
Yeah. Probably that. Yeah.
Wow.
Crazy. Long time.
So the man, the myth, the legend. Tell us a little bit about yourself, and let's get to this. I want to know.
All right, I love it. A little bit about myself. My goodness, where do we begin?
At the beginning, let's do it.
Go to the beginning.
God. Once upon a time.
So everybody always asks the question, you know, how come I have such a unique name? You know, so like if we're gonna bring it back, my dad's from Spain, my mom's from India. They met in India. They had me, and they moved to Long Island 6 months later. So why I have an Indian first name is because of the mom, and last name Spanish because of the dad. So it's very unique. I know it's a very mixed culture, and that's what's great about New York.
Absolutely.
Yeah.
Absolutely. Well, definitely.
So
welcome.
Thank you. So I appreciate you guys having me here. I'm very excited. So I guess my background and I guess my story, you know, during college, I was you know, looking at work, and I was working at a mortgage company doing telemarketing. So I started from the bottom and worked my way up. And after college, the manager from the mortgage company was asking me what I was doing. And I was like, you know, I'm trying to figure out if I want to go to grad school or do I want to travel? And he's like, why don't you work here? We'll train you. And when you want to leave and you want to figure out what you do, go ahead and leave. And I said, okay. My first year, just graduated college, 22 years old. I made my first $100,000, and I was like, more than that actually. And I was like, wow, this is amazing. Like, I can't believe, you know, I made this much money doing something I'm really good at doing. And so, not thinking this was going to be my career, I kept it going and I followed it. And then the mortgage industry changed in 2001. The market skyrocketed. I'm sure you guys all remember. And that's when the programs had opened up, stated income, adjustable rate mortgages, and my career just followed through. 2008, the crash happened, and you know, I figured out a way to pivot the market. And you know, you guys don't even know, in 2011, I started doing some flips, kind of like a side hustle, but you know, my primary job was still mortgage financing. And you know, listen, and 26 years later, I figured out a way to expand my career, you know, continue my knowledge, sharpen my tools, and you know, and I'm here today, 26 years later.
Nice.
Very nice. Very good.
Yeah. Awesome. So let's
which is very good, especially when we deal with clients. I think like that whole, you're a homeowner yourself, you doing investments as well, so you're in the shoes of those buyers, you know what's going on.
Absolutely.
You do some of your lending programs for yourself, you know, like, and it's good because you can relate to your consumer base. So it's really, really nice. And then of course you're well spoken, you present well, so that helps. There you go.
Thank you.
Yeah. So let's talk about what you're good at, actually navigating those different ups and downs of real estate, since you've been doing this like 250 years like I have. So you've been there, you've seen it. You can't say you've seen it all, because this time you haven't seen that yet.
Yo, what is it? Vampires are in mortgage and real estate? Vampires are in mortgage and real estate. 250 years in real estate.
Yeah, pretty much. That's what it feels like, right?
Yeah, seriously. No, it's definitely advantageous that I'm a homeowner, I'm an investor, I'm an Airbnb holder, I'm a landlord, I'm a mortgage banker. So I hold many hats, but I've also had so much experience. And it's good because I tell my customers I use that experience to help them, you know, like, how do you use real estate to hedge your future, right? What are opportunities that you can gain that I've experienced that I can transfer to you, right? Investments in properties, Airbnbs, buying your first home. I give them all that experience and explain that to them. You know, one of the things that I tell a lot of my customers is that, you know, having that experience is very important. But I also understand what it's like to be a homeowner, right? I've been in their shoes. I've gone through the mortgage process multiple times, my personal self. And so I basically take my experience and my own knowledge and transfer that to my customers. And that's a big thing because I can relate to them. And that's really important. The pains, the process, which is why I really give myself a big credit, because I want to make sure that my customers never experience the negatives of the mortgage process. They only experience the positives, right? So preemptively understanding what's necessary, making sure they understand everything from the get-go, the paperwork, the process, the time frame, what could be problems and what to expect. I believe that managing their expectations is a huge piece, because you never want to set someone up for disappointment. You want to set them up for success, right? And that's how I see it. Like, make sure they understand how do rates work, what are the paperwork that can be involved, what are the time frames and what could be delays, so that way they can expect that and not be surprised, because nobody likes surprises.
Absolutely
no
not.
one does. Yeah. All right, let me just write up some comments directly on Facebook. I want to make sure everybody
absolutely
logs in. I know.
So I mean, I really want to get into this right away, in the sense that we were just powwowing like a couple of days back in reference to what you can do, or what's the newest thing, or what's really happening out there. And a couple of things that would intrigue me was obviously, the information that you provided, where it's something that's better than pre-approval. Something that actually gives the buyer a better edge than everyone else. So why don't you let us know how they can leverage that information and what they actually can do now?
Yeah. So my company, Cardinal Financial, they offer what's called pre-commitments, right? So essentially, we all understand that right now it's a seller's market. There's a lot of competition, and everyone's fighting tooth and nail just to get a home. So we need to make sure that our customers have a way to decipher themselves and put themselves ahead of the competition. So how do they do that? What we do is we give the customers the opportunity to do what's called a pre-commitment. So what is that? Basically, it is their documents going through an underwriter, just like when you go to contract, going through the whole same process. So they do background checks, they do verification of employments, they're looking at their bank statements, they're looking at their income to make sure that they legitimately qualify based on the information we provide them. And then the underwriter actually gives them a written commitment letter. So the customers are now getting vetted by myself, who's an experienced loan officer, and an underwriter. And they're getting two documentation that says, look, I've been vetted by two people who are professionals who are showing that I have the ability to get a mortgage. So why is that important? Because a lot of times when listing agents look at these documents, they're actually saying, did you actually check their tax return? Did you actually verify that they qualify? So now you have two people who are verifying it, who are both professionals, and that's actually a lot more stronger than what some of the documents that are other buyers are getting.
I'm seeing documents where it says a verbal approval. So we're like, okay, yes, documents have not been looked at. They just called some guy who gave them a letter, and those are not, even though, and I see a lot of agents not realizing what, they just stuck on having the actual pre-approval for the sake of having the pre-approval, but it goes beyond that, it goes way beyond that, especially if you're going to deal with a tougher product like a co-op. And this, so that would be a much better having a pre-commitment on a co-op with a mortgage specialist who knows what a co-op is. That's a great tool, I think.
Absolutely.
I mean, it certainly adds for the agent, at least hopefully for the agents that are reading this correctly, is
buyers too.
Adds a peace of mind to it, right? And honestly, like, you have a buyer who's already went through the sort of the second and third step of the buying process.
Yeah, I mean, we have some. I hear you, little dog.
You're excited about the podcast.
It's okay.
So I'm hearing from agents lately. I have an agent who admitted to me she's put 26 offers on this buyer in Long Island. I know. And the guy is a conventional loan. All right, is a 5% down, which is a lot of. I bought my first house at 5%, so I see the pain. I mean, it's like you having a good job, you're having a nice salary, but you're cash poor, and when you're younger, that's what happens, right? And she has not shown me her pre-approval. I was telling her now. That pre-approval is running on 3 months. That would be the third time you need to do the pre-approval now, because now they've been looking at properties forever. Imagine how frustrating it must be for them. And I'm like, she didn't want to show me the pre-approval. I'm like, I want to see who the bank is. Maybe, that pre-approval is a problem. Maybe we need to restructure things differently, because a 5% down payment should not be an issue when well presented to the listing agent and the sellers.
True. True.
Yep.
So yeah, so definitely would recommend. I did recommend her the desk underwriting approval. You know, let's see what it is. So, and I've heard some other comments too on the more seasoned agents, especially those that are doing listings, that are totally adamant and against DU approval because, and listen to this, it's too invasive. The information of the buyer is out there, you know, too much information. What's your take on that?
I mean, like, listen, I think that
it's like whatever.
It's tough. No. It's tough because there is a lot of information that's on the DU approvals, right? And listen, DU approvals it's data entry, right? I can say I'm a doctor who makes $1 million, and if I don't document and show $1 million, what does it mean, right? So it's data entry, and basically what it does is it's reading what you're telling it and basically comparing that to the guidelines and getting an approval. So it doesn't really hold a huge bearing. You know, that's why like these pre-commitment letters are so strong, because it's a professional underwriter who basically, like the way I tell customers, it's like when you go to court, right? It's the judge giving a stamp of approval, because the underwriters are the final decision makers, who are the ones who give the clear to close, who make those decisions, who understand the guidelines. So when an underwriter is putting on a piece of paper, hey, this is a customer who definitely has the ability to get a mortgage because we checked them out and they fit the guidelines, it supersedes those DU approvals, right? It's like someone who's actually looking at everything and making sure it's correct.
Yeah. So what would you tell a listing agent, you know, like that are, you know, listing agents are totally dismissing a buyer with a 5% down on the conventional? What would be your advice?
See, a customer with 5% down and 20% down, and let's take away appraisal issues for a second, their ability to get a mortgage is equivalent, right? There's no differential, right? Someone who has a 700 credit score putting 20% down is not going to be better than someone who's putting 5% down and has a 740 credit score, right? They both have the ability to get a mortgage because there's so many factors that are involved. Debt to income ratio, the amount of reserves, you know, their credit scores, their credit health. Do they have foreclosures? Do they have bankruptcies? There's a lot of nuances that are involved and risk categories that are part of it.
Right.
So it's not just about, hey, I've got 20% down. You know, I could be a 640 credit score, put 20% down. Okay, cool, I put 20% down, but am I better than the guy who's putting 5% down and he's got 740 credit score? So there's a lot of factors that are involved. It's not just about down payment. So I agree with you. Like, don't be afraid of someone who's got a 5% down. That doesn't mean that they're not qualified to get a mortgage. And to a seller, your net is still going to be the same. You're still going to make the same amount of money. Agree?
Right. But it's very hard. I'm finding this conversation. I'm usually on the listing side, but I'm finding this conversation to be really, really difficult with listing agents who are just favoring the more down payment, the better. And, you know, and that's how they're presenting it to the sellers. And it's not necessarily always the case, you know, and this is where we need to get more educated.
I think they're concerned about the probability of them getting the mortgage with issues with value, with issues with maybe, you know, debt to income ratio. They're concerned that someone who's 20% is stronger than somebody who is putting 5% down, which is not the case. And it's just about education, right? Like if I have a 20% borrower who's got a 49 DTI versus a guy who's putting 3.5% down and he's got a 24 DTI.
Yeah, it was his choice to go with the lower down payment because he could, and they could be doing something else with their money and whatever the case is. Yeah, I know.
Yep.
And they shouldn't be penalized. But
Going back to the pre-commitment, so you talk about low down payment. So it's funny. We put an offer in for a customer Tuesday, and the offer got accepted Wednesday. The listing agent called me and was actually saying, Amrish, I'm so happy you're on this deal. I got the commitment letter. We love what Cardinal does is because they actually vetted the customer, and I see that it went through underwriting. And actually, we know for a fact that when you guys put it, it actually makes the process go faster too. Because once we go to contract, the mortgage process is super smooth because they already did all the homework. So they were so excited that we were the one doing the financing for the buyers and that I was on the deal. They accepted the offer actually because of that. They actually got $10,000 over asking for a conventional loan, and they took ours because they felt way more comfortable and securitized because we did the loan and we had to pre-commit it.
cool.
So pre-commitment is when you basically qualify, like you literally take them through the application process.
They actually go to underwriting.
Minus whatever the property,
minus the appraisal,
minus down payment check, minus the contract, minus the appraisal,
and minus the verifications at the end, the re-verifications and all that. Yeah.
So then typically time frame, right? Nah, I mean,
it's quicker.
There's going to be a perfect setting. What would you say would be that time? Like
if that's the
case, if somebody gets a pre-commitment, like this case, right? Client went into contract. I mean, they got an accepted offer. You know, you guys are the ones that are doing it. Is the contract already fully executed or not yet?
We don't give them a fully executed contract. There's no contract. It's really
I'm saying with the buyer, did they already get fully executed contracts or not yet?
Not yet.
No.
Okay, so when they do, what would you say the time frame would be if everyone does everything according to plan, like step by step? As soon as they get it, they take care of it. What would you say the time frame would be to get them from closing, from the signed contracts to the closing table?
I mean, from signed contracts to the closing table, even a perfect world, we get title, everybody cooperates. Honestly, 2 weeks.
2 weeks. Wow.
Because you see, Ed, what you have gone through that section of underwriting. So they looked at all the document pertaining to the buyer. So that's already like saving you days. It's like you already have pretty much have the application, you know, like you're going through the whole application process. Yep. You know, then once you go to contract, all you have to do is call the order the appraisal, have that appraisal done at the same time. You know, so it shouldn't take more than a week or so. Yeah. And then you're ready to issue commitment and then run the title search and stuff like that.
Correct. I mean, like a lot of the T's have been crossed and I's have dotted. Like verification of employment, that actually can be one of the biggest things that slow a process down. That's already ordered. We have it. It's already done. They've done background checks, right? So like, what people don't know is all underwriters usually do what's called a LexisNexis search or some sort of background check, just to verify, do they own other properties? Have they had a foreclosure that maybe we don't see on credit? So they do these background checks ahead of time during the pre-commitment process. So when you go to contract, we already did that. So there's a lot of work that's normally needed that's already been done that saves time.
And most of the time, a lot of other lenders, and whatever, it is what it is, but a lot of other, for whatever reason, most of the time, that's not what they do. They just kind of go through like a verbal qualification, right? Like they'll ask questions. What's the income? What's your credit? What's your debt? Right, what do you have in down payment? Okay, cool. Here's a pre-approval.
That's exactly right. Like, what's your name? What's your social? What are you looking to buy? Cool. Here you go. And that's not a true pre-approval. Like, you actually need to make sure these customers are vetted because there's so many nuances that are involved when it comes to getting a mortgage, right? So if someone's self-employed and I say, hey, I own a business in construction and I've done it 10 years and I made $300,000, that pre-approval should not be valid because when you're self-employed, you don't really make $300,000 because you write off everything, but you write off a lot.
Correct.
So the bottom number is what you have to qualify somebody with.
Yeah.
No,
so
right.
while we have you here, and I know the co-op question came up before, I don't know what the rules are with Cardinal Financial or what they do, but if you
they do co-ops in the city, they do a lot of co-ops.
So with that being said, I mean, if you come across a building that has a land lease with an expiration date set for 27 years from now, ideally, hypothetically
20
speaking,
or 15 years.
20, is that all that's being given because of the land lease?
So I'm sorry, I lost.
Sorry, here's my question. So if we have a client that's looking to purchase a property and the land lease is set to expire in 27 years, are you still able to give them a 30-year mortgage, or will it have to be a 20-year mortgage? Or
this is where they have a co-op department. I'm going to answer like all those banks have co-op departments and they're taking those things in consideration. And I think I know which complex you're talking about. It's a huge complex in Queens, in northern Queens, correct?
Mm-hmm.
That is on the land lease. Chances that it will get renewed are very that the land lease will
100%.
Get renewed.
It's 100%. Actually written into the agreement.
I wouldn't say 100% because you never know, but the chances of that lease being renewed are extremely high. Mm-hmm. Yes, and it's less than 30 years. And I know some banks are getting scared, I think you would have to go with the history of complex, like looking at would they look at, this is like another department, it's not even on the loan officer, right? So it would be on the approval of that complex.
Right. Like we have a co-op department that looks at everything and they're going to make a decision whether it's high risk or not. Right. So like
they're going to look at the ratios of owners versus investment units or sponsor unit, how much of it is rented, what is the risk factor. But in this case here, since, I don't think it's going anywhere. I think there is a lot more of the urban rumors on the co-op and then us real estate agents probably making it worse than what it is.
Yep.
I think that's my take on this.
But
look, co-ops are businesses, right? Like you guys have to understand, like when you have, and this is how I tell customers, co-ops have budgets and financials and insurance, right? So it's a business, right? If you have 10 individuals that are in a building, there are 10 units and they're all paying $1,000, they're collecting, $10,000 a month. And every year they're spending that money on the garbage, the taxes, the blanket mortgage, the insurance. So it's a business. So when we look at it, we have to see, how is the business being operated? Is it profitable? Are they spending things the right way? Do they have savings that they're putting away? And that's what the co-op department does. And I've looked at this stuff with attorneys. We've looked at financials, budgets. We've looked at all this stuff. So, and you guys know I've done this for a very, very long time. Co-ops everywhere, Brooklyn, Manhattan, Queens. So I'm very well versed in what they're looking at. So it's all about risk, right? Are you guys putting enough money aside to cover your risk? If there's an emergency, is your blanket insurance covering if there's damages that are involved, right? Are you financially strong every year? Are you guys improving your financial expenditures? So they look at all this stuff, co-op departments, we do, and they say, look, is there a risk? Now, to answer your question, Ed, is it possible to do that? It is possible. We have to understand, what is their game plan? What are they going to do? So 27 years happens, then what? What are they? What's their plan, right? Yeah. A lot of times there are co-ops that are under budgeted. Their financials are not strong, or their budget is very weak. And I had a case where they were in the negative. And we were asking them, what's going on? Why are you guys in the negative? What are you doing? How are you going to fix the problem? Because you can't run a business and be in the negative. You all know that. Yeah. So how are you getting out of that? What's your game plan? Because in years before, when we looked at your history, you guys were on point. So what's happening? And they explained, look, we all know inflation, costs have gone up. They haven't changed any of the owners' maintenance fee. They've kept it the same for the last 6 years. We were shocked. 6 years. You haven't adjusted once. So they have to pivot. They're going to have to adjust, and they're going to have to increase maintenance fees in order to cover their expenditures so they can get back into the green. And so when we had a conversation with the management company and the board president, they all agreed, we've got to raise, we have no choice. We have to raise everyone's maintenance fee. And there was, I think, 240 units in that co-op building. And so it's going to take them about 1.5 years for them to recoup the lost costs and to put money back into the account.
Wow. Right. And then, I think it's also how, responsive the co-op is. And when we talk about the co-op, they're being represented by, they're being, they via management. So if management is not responsive and willing to share some information and dragging on the condo questionnaires and stuff like that, I don't know, it's hard for buildings to be approved by certain banks,
Now, the thing I need to understand is also, are we also taking this as far as the umbrella of not only co-ops but also condos? Because there's that different, sort of product, but also under the same situation. Yeah. Right. Condos, obviously, if they've been around for a while, they do also have a board. They also have management. They also have financials, right? But they're not being run as a business. To my understanding.
That's not totally true, actually.
Okay.
It's still a business. It's still an association of homeowners.
Mm-hmm. A lot of condos have boards, in fact.
Yeah, they do have boards. Yeah.
It's just really.
It's like co-ownership. So in order to run the co-ownership, they sort of have to run it like a business. Mm-hmm. And they have to hire subcontractors to run that. The whole. You're gonna have staff. You still need the accounting part for the financials and so on and so forth. So it has to be run parallel to a co-op.
Yeah. Condos and co-ops definitely have a lot of differences and similarities. I mean, condos are businesses, right? It's not a single dwelling, it's a multiple dwelling. So you still have maintenance fees, and you still have a management company who's spending on blanket insurance and things like that, right? With condos, the owners are typically responsible for their own property taxes. So that's a big differential. And with condos, you own the property, right? That's your property that you can do versus a co-op where you're a shareholder. But I definitely think that condos are still the same similarity when it comes to running a business, right? You don't want to have an under budgeted condominium, because what happens is when you have an under budgeted condominium, guess what? Those maintenance fees go up. Why do lenders care about that? Is because it's affordability, right? So with condos and with co-ops, if your maintenance goes up, can you afford it for 30 years, for 25 years, for 10, 20? They look at the longevity and say, if your maintenance is going up, do you still have that debt to income ratio to keep it going? Does that make sense?
Yeah. Yeah, it does. It does.
Yeah, definitely. Sorry.
It does. Yeah. Can I ask a personal question? Since
Absolutely.
I've seen you working with other financial institutions, and I know, and I'm probably gonna. I was, for some reason, I knew of Cardinal Lending. Was it Lending? They used to have that, whatever. What I think they changed. Yeah, financials. I know. Yeah. I know of them because of a lot of the financing they did in Manhattan with co-ops and condos. And I'm like, and through you, of course, I'm seeing, and I'm sure you're doing a lot of residential. Are they more known for co-op condos, or are they all over Long Island? And because to me, it was synonymous to Manhattan financing.
Yeah, so like Cardinal Financial is a nationwide company, and we can lend in any state in the country, right? So they are all over Manhattan, they're all over Jersey, they're all over Long Island, New York, Queens, Brooklyn. I mean, they're all over. They're growing quite exponentially. We are a direct lender, so we're not a mortgage broker. So we actually service the loans. What's interesting is that the mortgage statements actually have my photograph with my information on every single statement. So every time the customers get a mortgage statement that's serviced by us, they can actually see my information with my photograph, which is interesting. So I'll get customers who send me screenshots. So like, oh, your picture still looks pretty good, although you need to update it because you look like you're 16 years old. I'm like, oh, it's because I grew the beard.
Yeah. All right. That's good. That's good. All right.
So what other, I mean, so now that we already know about, pre-commitment, what other programs or what other, strategies we can go with as far as, beating the other competition? What do you think?
Yeah. I mean, there's a lot of programs that customers have the opportunity to utilize. I think one of the biggest things I'm noticing a lot is that people are using the buy down products, 3-to-1 buy down, 2-to-1 buy down, long-term buy down. Obviously with rising interest rates and where the market used to be back in 2020 and 2021, people are now utilizing these like buy downs to soften the monthly payment so that way they can increase their affordability. So that's been a very popular thing that I've been noticing recently. Adjustable rate mortgages are now becoming popular.
I was going to go and ask you adjustable.
Yeah, adjustable rate mortgages are popular. And I think with adjustables, I always tell customers, remember, like, your temporary fix is going to eventually expire. So remember that, because if you take a 7-year fix or a 10-year or a 5-year, remember you should have a game plan of what's going to happen after that expires. And I like to remind that to them because, circa 2008, when the market started crashing, a lot of it was because of adjustable rate mortgages, because rates had gone to the adjustable part and it went up and people's affordability level changed. And all of a sudden people couldn't afford the mortgages that they took out in 2007 and 2008 and so on. So, flash forward 15 years later, I like to remind customers, listen, it's cool. Go on for that adjustable rate mortgage. It's fine. Just remember, make sure you have a plan. For me, I like security. Security for me, 30-year fixed. I just like to know that my payments are always going to be the same and I don't have to worry about it. And listen, if rates change and they go down, I can refinance. There's no prepaid penalty. So I have the opportunity to refinance.
Right. Can we get your take on what's I always want to ask, what's your take on the rates, the behavior of interest rates over the next couple of years in America?
Interest rates, it's a very interesting question. That's obviously been the topic for the last probably 2 years.
Everybody's asking you. That's what you're a mortgage guy. Everybody's going to ask you.
Literally, I'll go to a bar. The second I say mortgage equals rate, right? That's always the first conversation.
What are the rates nowadays?
Right.
Right.
What are the rates?
They going
They
up?
don't even ask me what I want to drink. They're like, what are the rates? I'm like, at least buy me a drink, for God's sakes. But yeah, listen, rates, my theory about rates is that everybody is so focused on what happened in 2020 and 2021, and they forgot that prior to that, rates used to be 6%, 7%, 8%. When I started the mortgage industry in 97, 9 and 10% were the normals. People were getting second mortgages at 12 to 15%, and that was good. My parents bought their house in 1979, and they paid 21% in interest.
I know.
And they didn't say, what's the rate? They said, what's the payment? Because you got to remember, you don't write your check to your rate, you write your check to your payment. So look, what I tell customers is don't be afraid of what rates are today. There's a phrase in real estate we talk about: marry the home, date the rate, right? Your home is forever, but the rate's not. You can always have the opportunity to refinance. So don't be afraid where the rates are. Don't be on the sideline hoping that rates are going to go back to 2%. You could be waiting for the rest of your life. Your kids could be waiting for the rest of your life, right? Like, we don't know what rates are. We don't have a crystal ball. But the opportunity of real estate, you have to think about what it's going to do for you. And I give them my example, right? So I personally bought a property, one of my investment properties I bought in 2019, and before the market went where it was.
Crazy.
And exactly. And my rate then was at 3.75. And I didn't say what was the rate. I said, hey, what's my payment? And that same property that I bought for 170 is now worth 400,000, right? So I said to the customer, if you have an opportunity to make 230,000, irrelevant what the rates are you going to take that opportunity?
Absolutely.
Right?
Absolutely.
And that you have to focus on what real estate's doing for you. Now, don't get me wrong, affordability is very important. You have to be able to afford your mortgage, right? And that's what we do. We basically explain to them, this is the ways to afford your loan. So you're going to pivot. Maybe you got to pay a little less in taxes. Maybe you got to go a little bit out further to Suffolk County just to get something that's a little bit more to your price range. But you're going to have to pivot, and you're going to have to adjust. And then that's okay. That's what people have been doing through COVID, what people did back in the 80s when rates were 16%. Mm-hmm. Now, everybody asks me, what do I think rates are going to be? I think the norm is going to be 5 to 6% for a while. Honestly, I think rates may even hit 7%.
Ooh, what a climax.
Right? Like, what happened? Blackout.
Lost it.
Whoa. Climax.
You said 7%. Went to commercial.
Yo, this guy said 7%. The government was like, pull his plug.
Shut it down.
Shut him down. He's telling them too much. Get him off the line.
My phone got scared. They're like, whoa, that's too much.
Giving that sensitive information there, bro.
But I definitely think people should not be afraid what rates are. Honestly, like, don't let that mess you up, right? Don't live at home. Don't rent and pay someone else's mortgage. Don't be afraid what rates are. Think about affordability, right? Like, you don't write your check to your rate. You write your check to your monthly payment. So if that monthly payment is helpful for you, it's affordable, go for it. And I think, like, you guys are.
And there we go. Aww.
I know.
Yeah, there you are.
You're back.
You guys were mentioning before about how, sorry, I don't know what happened there. You guys were mentioning before about what's happening where, oh God, what were you talking about? You were just talking about with Ed, I think about where you were mentioning something about. Say that again?
Not the land lease.
Oh, no. Before that, there was something when you guys were in your chat without me.
Okay.
Shoot, I forgot what it was about.
In the beginning.
Yeah, well, as
we were just talking about it. As you're thinking about it, Fernando actually asked a really good question. On a buy down, do buyers qualify at buy down rates or current higher rates?
Yes, that's what I was going to post earlier. Yeah.
Good question. So yeah, it goes off the current rate and then they buy it down based on the current rate, right? So let's say, for example, they do a 2-to-1 buy down. Basically, they take whatever the current rate is and they get 2% less for the first year, 1% less for the second year. And then years 3 through 30, they get the market rate.
So hypothetically, if we're at 7%, 2-to-1 buy down would be you would be at 5% the first year, 6% the second year, and then whatever the current rate is for the following year, for the third year.
But then you have the opportunity to refinance then, and hopefully it will go back down.
Hopefully.
Correct. So it's kind of like a soft walking into your property, right? It's like a soft entrance into the property. And remember, people's income consistently goes up, right? So like ideally, you want to continue to make more money as you progress into your career.
Yeah,
that's true. It makes a lot of sense.
It's like,
I had a single guy buy a house, and he's like, "Man, I'm going to do this 3-to-1 buy-down." And I'm like, "Hey, man, hopefully you'll meet a girl. She has income. She helps you get involved with the home." And then now you have dual income to help afford the property.
You got 3 years, man. You better find her.
Within 3 years, to be like your dad, you better get married, man.
You got 3 years to do better at work. Get an increase in pay.
That's what Gigi said to me 7 years ago. She goes like, "When are you getting married?"
I know.
Remember that?
Remember? I know.
Cow,
I followed your advice.
I know.
That's actually really good, though. Wow.
Yeah, I'm glad.
Yeah, so great question, Fernando. Thank you.
I don't think, this is 40 minutes. This is fantastic.
Yeah.
Oh, wow.
I think we don't have to beat a dead horse on this one. Did we put Amrish's information?
Yes, we did.
Yeah, this is a great way for Amrish to, how can they contact you? I mean, we'll put the information at the bottom, but.
Yeah. So again, my name is Amrish Dias. I'm with Cardinal Financial. You can reach me on my cell, 516-860-6238. My email is my first name .amrish.diaz@cardinalfinancial.com. That's a bit of a long one. You can find me on Instagram. I'm Rish the Mortgage Banker. And please follow me. Ed is actually correct. I do a lot of interesting and different functions. Sometimes I'll do a little hobnobbing, but that's a whole different thing. But yeah,
hobnobbing. What's hobnobbing?
Listen, I remember the first time I met Amrish. We clicked, man. We spoke. Great conversations, man. I picked your brain on some different programs, but then he invites me to his birthday party in the city. This was like 4 years ago. And he's like, "Yeah, come through, man. You want to come?" I'm like, "Yeah, I mean, sure. We just met. Whatever. I'm with it, I stopped by with Priscilla, and man, I was not expecting it to be the way it was, man. This guy knew everybody. Everybody in there was just like, "Yeah, Amrish, and happy birthday," and he's taking pictures. I was like, "Holy cow, man!"
Yeah,
I had
that was a good party.
Man. Yeah,
that was a good party.
It definitely was. It definitely was, man. But,
right.
Brother, we appreciate having you on. Thank you
guys so much. I appreciate it.
Thanks for tuning in, dropping them gems. I definitely took some notes on that, and I will be sharing a story on Instagram. I'll tag you.
Okay. Perfect. Tag me, please.
And we need to name our MVP of the day.
Oh, that's right.
I think it sounds like Fernando to me.
Yeah,
you know what that
definitely.
is? Our most valuable post.
Nice.
100% is definitely going to go to Fernando.
Yeah.
So,
all right, guys.
Appreciate it, man.
Awesome.
But all right, guys.
Thank you again, Amrish.
Thank you. It was a pleasure.
As always. And this weekend,
you owe me a visit. We've been phone tagging for a long time.
I do.
You know where I'm at.
Absolutely right. You're absolutely right. 100%.
So don't forget, this weekend is Father's Day. So make sure you guys go out there, spend some time with Poppy.
Yeah.
All right.
Yeah.
Tell Poppy you love him. Give them a call if they're not close by.
I didn't even tell you guys I'm actually becoming a father soon.
Yes, that's right.
Whoa! You heard it here first. Let's go. Congratulations.
You heard it here first.
Right.
Future Poppy.
Future Bobby.
Diaz. Poppy Diaz.
That's right.
All right, guys.
All right,
guys.
Until next week.
Take care.
Yep.
Have a good time.
Great weekend.
Music. That's it.
Buddy. Oh, yeah. Where's the music at, yo? DJ.
I thought it was on already.
DJ. There you go. We got our grown-up
Have a great
music.
weekend.
I know. Bye, guys.